Assalamualaikum. Right now, my group is going to briefly explain about Aeon's company financial ratio result. First and foremost, we start with the background of the company. Alright, Aeon Company is a major retail company in Japan, founded in 1758. It became Jasco in 1970 and was renamed to Aeon in 2001. Today, Aeon is one of the largest retail groups in the world, offering supermarkets, discount stores, and e-commerce services across Asia, including Japan and Malaysia. The company focuses on community engagement and customer satisfaction, and also guided by its mission to promote peace and respect humanity. With around 300 subsidiaries, Aeon continues to thrive by adapting to local markets and consumer needs, which highlight the importance of financial ratios in assessing business performance and making informed decisions for sustainable growth. Alright, financial ratios are crucial for assessing a company's financial health, enabling stakeholders to make informed investment and operational decisions based on its financial statements. They also provide a standardized way to compare companies across different industries, facilitating fair evaluations of performances and identifying areas for improvement. Today, we will delve into the comparison of two different years for Aeon's company liquidity ratios, which is an essential financial metrics that measure Aeon's ability to meet its short-term obligation using its most liquid assets. Monitoring these ratios help companies to identify the potential cash flow problems before they escalate, allowing for timely adjustment in operation or financing strategies. What is the current ratio? One of the most commonly used liquidity ratio is the current ratio. This ratio is calculated by dividing a company's current assets by its current liabilities. Now, let's take a look at the current ratio of Aeon Company for two consecutive years. For 2023, the current ratio is 0.51. For the 2022, the current ratio is 0.50. From this data, we can see that the current ratio improved slightly from 0.50 to 0.51. This marginal increase suggests a slight improvement in leverage, indicating a more aggressive use of debt relative to assets. Despite this increase in the current ratio, it's important to note that the overall financial position remains stable. Both years show similar levels of leverage, which point to consistent financial management practices within the company. However, this slight increase in the current ratio could imply a higher financial risk in 2023 compared to 2022. Therefore, it may require closer monitoring of debt level and interest obligations moving forward. Now, next we're going to explore the quick ratio of Aeon Company, also referred as the acid test ratio. This metric is vital for assessing a company's ability to meet its short-term obligation using its most liquid assets. In simple terms, it measures how well Aeon can cover its current liabilities without relying on the sale of inventory. A higher quick ratio indicates that the company is in a better position to handle financial emergencies or unexpected expenses. We have a data for two consecutive years. So, for the 2023, the quick ratio is 0.14, while the other one is 0.17. The quick ratio decreased from 0.17 to 0.14. This decline suggests that Aeon's company has become less capable of meeting its short-term obligation with its most liquid assets. A quick ratio below 1 signifies that the company may struggle to cover its current liabilities without relying on inventory sales. This is concerning because it indicates potential liquidity issue that could arise during financial emergencies. The decrease raised significant concerns for investors and creditors regarding the company's financial health and ability to handle unexpected expenses effectively.
Thank you, Daniel, for the wonderful presentation. Next, let's proceed with the debt ratio. Over the past year, Aeon has shown improvement in this metric. In 2022, the debt ratio was 66.7%, which decreased to 64.4% in 2023. This reduction indicates that Aeon has lowered its reliance on debt to finance assets. It suggests improved financial leverage and a more cautious, equity-driven approach to achieving financial stability. With the current ratio of 64.4%, Aeon is positioned with a healthier balance sheet reduce financial risk and enhance long-term sustainability. Next is the times interest earn ratio, a critical indicator of Aeon's ability to service debt. This ratio has remained consistent at 2.84 times for both 2022 and 2023. The calculation involves by adding EBIT values for both 2022 and 2023. A tie ratio of 2.84 times reflects that Aeon can cover its interest expenses nearly 3 times over, showcasing stable debt servicing capacity. Although there hasn't been an improvement in this area, maintaining this ratio signals financial stability, which is crucial for effective debt management. These ratios illustrate Aeon's progress in managing financial obligations effectively. The reduced debt ratio and stable tie ratio underscore the company's commitment to achieving long-term financial health while ensuring steady operations. Next, I will pass to Faris Zaki to proceed the presentation.
Thank you, Danish. Now, I will be analyzing the asset management and efficiency ratios of this company for the year 2022 and 2023. Let's begin with a brief definition. Asset management ratios measures a company's efficiency in utilizing its asset to generate revenue. These ratios help us understand how well the company manages its inventory, collects payments, and uses total assets to achieve profitability. Starting with the inventory turnover ratio, this measures how efficiently the company sells and replenishes its inventory. In 2022, the ratio stood at 4, meaning the inventory was sold and placed 4 times during the year. In 2023, the ratio increased to 4.31, reflecting better inventory control and quicker stock movement. This improvement indicates the company could meet customer demand more efficiently. However, while this is positive, further optimization in inventory management could reduce holding costs and improve profitability even more. Next, the average collection period measures how quickly the company collects payments from customers. In 2022, the ACP was 6.8 days, which slightly increased to 7.87 days in 2023. This rise suggests potential delays in customer payments, possibly due to more relaxed credit terms or slower repayment patterns. While this longer collection period could support customer retention by offering flexibility, it may also strain cash flow. To address this, the company should consider tightening credit policies or introducing early payment incentives to maintain liquidity. Finally, the total asset turnover ratio shows how efficiently the company uses its asset to generate revenue. This ratio rose from 0.76 in 2022 to 0.79 in 2023. Although the increase is modest, it reflects better resource utilization and operational efficiency. For every 1 ringgit of asset, the company generates 79 cents in 2023, up from 76 cents from previous year. To build on this progress, investing in technologies or strategies to boost asset productivity could be a valuable next step. In summary, asset management ratios highlight positive trends in inventory management and asset utilization, but also reveal a need for improvement in cash collection practices. By balancing operational efficiency with effective financial policies, the company can further enhance its performance and financial stability. That is all from me, and I will hand it over to Faris Azad for his presentation. Thank you.
Thank you, Faris. Now I'll be sharing key insight into Aeon financial performance, focusing on operating profit margin, net profit margin, return on asset, and return on equity. So, let's start with operating profit margin. In 2023, Aeon recorded an operating profit margin of 7% compared to 8% in 2020. This decline highlights increased operating costs, which slightly impacted efficiency in converting sales into operating profit. For every 1 ringgit of sales in 2023, approximately 7 cents remained as operating profit, down from 8% in 2020. Moving to net profit margin, despite this operational challenge, Aeon maintained a steady 3% net profit margin across both 2022 and 2023. This reflects strong control over non-operating costs such as tax and interest, ensuring consistent overall profitability. So next, return on assets. Aeon return on asset was consistent at 2% in both 2020 and 2023, showing efficient utilization of asset to generate profit. However, improving profitability and asset efficiency could enhance this metric further. Finally, return on equity. Aeon return on equity remains stable at 6% for both years. In 2023, the company achieved a net income of 140,832 with total equity at 1,859,012, giving an return of equity of 6%. Similarly, in 2022, with net income of 111,232 and equity of 1,807,028, the return of equity was also 6%. Thank you. That's all from me. In summary, Aeon financial performance over the past 2 years show a mixed stability and gradual improvement. The company liquidity measured by the current ratio slightly improved and its debt ratio declined, indicating reduced reliance on debt and better financial leverage. Profitability metrics like operating and net profit margins remain stable despite a slight drop in operational efficiency. Asset management ratio highlighted better inventory turnover and asset utilization, although the collection period slightly increased, signaling potential cash flow challenge. Overall, Aeon demonstrates consistent financial management with room to improve profitability and operational efficiency further. This positions the company well for future growth while maintaining stability. That's all from us. Thank you.